All right, we're recording, and it is D-Day. It is June 6, 2024,
garbage.
which
It's
is
deadly.
and I'm going to
No,
mute you if you don't
watching this.
mind. There you are. Okay, as I was saying, it is June 6th, so it's exactly 80 years ago, I think, that D-Day occurred. How about that? And it is a beautiful June 6th in Steamboat Springs. I'll tell you, it is picture perfect. Everything is green. Behind me is actually the Yampa River. I don't know if you can't quite see it, and it is right at the banks. I mean, it is running full, and the rafting operators are delighted about that. We've had kind of a slow melt, so it's been a good season because we've got a lot of snow. If I can see Mount Werner right out the window here, and there is a lot of snow up high yet here. Just a great season. So that concludes our meaningless trivia. Glad to have you here. I'm Tim Quast, and with me is Henry Howard, head of our client services group. The guy who knows everything about the platform. We can actually ask Henry if we're not sure. So glad to have Henry here to tag team with me. I'm going to go first and then hand off to Henry. I have a number of things to cover, and I'll share my screen here. They are, there's been supply-demand convergence. So why didn't the market tank? I mean, it's a reasonable question. Not that any of us want it to, but I like to, go long and short. Short, Barry Norton. I mean, you're the master of shorting. But sorry, I'm trying to do two things at once, and I can barely do 80% of one thing at a time. So I'm only doing it infrequently. And frankly, I would have thought there would be more. There was some opportunity this past week, but not quite what I had anticipated. So I want to talk briefly about that. I said I would in one of the market desk notes. Getting stopped out. Is that happening? I mean, and I'll tell you why it seems to, when and why it happens. And I think Steve Hicks, you talked with Brian a little bit about that last week. I want to show you what I look at that sort of gives a clue to what to expect there. Long versus short, entries and exits. And then I want to talk a little bit about CELH as an edge case. It may be something to look for. It was unusual. So that's my plan, and we'll see how this goes. So first of all, let's go to broad market sentiment. Here's what I mean. What you will find is that when demand is generally rising and remains fairly, if it's above 5, we're generally fine. It doesn't mean that the market will falter, but you will see, even here where there was this little dip in demand, the market flattened out, then supply declined and demand improved, and off we went. That in these instances, the probability that you can produce momentum returns in the momentum portfolio are very, very high. And you can follow the entries and exits, if you have a chance to buy half the volatility down, just flat, even up a little bit. The probability that you can capture 2% in a day to 5 days statistically is extremely high. When demand declines, particularly when it drops below 5 and supply rises, the probability that you can produce momentum returns deteriorates. It does. And this is where, to me, the probability that you get stopped out increases. And so then what do? And I'll come to that in just a moment. I'm going to leave that question hanging because I just want to finish the thought here. These conditions you would expect would produce what happened here. If you have demand that's falling and supply that's rising, what does the market have a propensity to do? Decline. Henry, are you getting those people who are knocking? If you do, that'd be helpful. Thank you. I can't tell. So then why didn't it this time? And the simplest answer of all is sometimes it doesn't. Sometimes it doesn't. But context does matter. If we're not in an expirations period where there are going to be resets to people's derivatives positions, indexes and ETFs that may use those things to true up tracking, then the math might not work. I'm not saying that it won't. I mean, we're right at a market bottom now. What we say is that when you get to that green line, it's just statistics, it's math. It doesn't mean it's an absolute, it's just a central tendency that you take 500 stocks, the S&P 500, and you track demand and supply over time. They spend a lot of time at about 5.5 because the market generally rises. Generally, more money comes into the market than leaves it. And generally, the number of products in the market continues to shrink. The number of public companies is declining, not increasing. Those conditions will generally mean that the market rises. The problem, of course, is when people take money out of equities, it can be much harder and much more devastating to the market because everybody owns the same stuff. And so the market can tip over. But the point of the 4.0 is that mathematically we find that tends to be a bottom for equities because equities will have declined enough that money returns. Right? They go down 2, 3, 4, 5%. Money comes back in, and the process repeats. And that point that they tend to correspond. So this is kind of interesting. And I have a short on the market today. I don't know whether I'll keep it or whether it'll work. It has worked so far, but it's because even though we're at a bottom, the market has not declined 2, 3, 4%. It may not. Why hasn't it? Well, I can only speculate. I can tell you that we're not, as I said, in a period where those things are resetting. Back here we were. So if the market declines and then all those options that people had did not materialize as they had hoped, if people were buying, selling volatility, and that didn't work out, or buying calls in the hopes that they could force somebody to buy in, and that didn't work out, then everybody lets all that stuff go, and all that implied demand becomes supply, and down the market goes. Well, we don't have that occurring right now. That won't occur till the week after next. Is that right? Let me think through that. Begins next Friday, I believe. It's some odd stuff here in the next number of days because there's a Juneteenth holiday, June 19. And so things are thrown off a little bit. But my point is, none of that's occurring here. And then secondarily, sometimes it's just new month, new money. I said in the market desk note, it would be telling. Are people continuing, are you and I continuing to contribute at the same rate to our 401ks? And it will show up. If economic difficulties mount and people can't do that, it will show up in the beginning of a month, generally. And has it happened? Well, certainly it doesn't appear so. I mean, I found that the market was incredibly volatile. I don't know if you saw it. You probably did if you were shorting the market. Unbelievable movement that no one even talked about. I didn't hear anyone on June 3rd talk about the dramatic moves in the market. And if you look at the intraday volatility, 3 days running, it was, I think, Thursday and Friday of last week, and then Monday of this week, maybe Tuesday too. It was incredibly volatile. Well, what creates volatility? Changing strategies. And volatility is nothing more than changing prices. Machines set prices and they react to whatever is occurring, and sometimes they react purely to data. They consume data and make decisions based on that data with an investment horizon of a day or less. So it's still troubling to me. I think that all of that volatility, there are two explanations for volatility. There is a change in flows, or there's a problem in the data. It's what it comes down to. So it's one or the other or both. I hypothesize that part of the problem might be T+1. I mean, it appears to have happened without a hitch, where we go from a settlement cycle of the trade day and then 2 additional days to the trade day and 1 day, meaning if you trade today, it's cleared tomorrow. That might have, would it have an impact? There were an awful lot of problems in the market that I didn't hear anybody really write about. I saw a thing or two. We saw, Berkshire Hathaway Class A shares trade to $185. Shouldn't happen. It tells you how machines set prices. What would explain something that is priced at $630,000 trading to $185? Well, it's the same way that Accenture traded to a penny in on what was it, May 6th, 2010, the flash crash. There at the time you could put in a stub quote. So traders would put in, an offer to buy at a penny, and the or a bid to buy at a penny, and an offer to sell at $100,000, because all they're going to do is make a market in between them, and then those happen to be the only quotes in the market. And so Accenture went all the way till it hit a bid at a penny. So that's outlawed. You can't do that now. The rules have changed, and the market won't do that. But it's not supposed to move like that. So there were clearly data problems. I'm not sure all of that has washed out. But I think, it's a very unusual event. It's not unprecedented. Sometimes there's a lot of money that comes into the market, and when demand and supply appear to indicate that it's not occurring, people exercise derivatives or hold or roll their derivatives positions. And so what we're tracking is the underlying equities. And if the underlying equities show a lack of demand, but the price doesn't move, most of the time that demand is probably in the form of derivatives. And that certainly could be the case here too. It's just that they're not renewing. So now how this feeds into,
question.
Go ahead. Yes, please, Steve.
Okay. Just before you leave this subject, I wanted to ask you, I've read a number of articles that have mentioned that the possibility is there that whole thing was a test to see what would happen if the algorithms actually did fail, to see how the brokerages would be able to handle it. The entire thing was a test for the SEC. Thoughts?
So I traded notes with Ronan. There's a guy named Ronan Ryan. If you've read the book Flash Boys, he's a prominent character in that book at IEX. He's the chief operating officer at IEX, one of the independent markets. I've known him a long time, and I said, "The hell's going on, Ronan?" and IEX was one of the outfits that had problems, and he said. So I can only, he's a really straight shooting Irish guy. Every, third word is a swear word because he's an Irish guy. He's a terrific person, just a really funny fellow. But he said, no, the SIP failed, the Securities Information Processor failed. We have a failover, and that failed. It only failed in a slice of equities. So that's what he told me. I don't, I looked at, we had a number of the clients of Modern IR, public companies who use data to track the market, who were volatility halted that day. I can only take him at his word. I saw this, I saw the self-helps. I'm going to get all that information where exchanges were having trouble. And what happens is the whole market is connected by law. It's part of Reg NMS, Regulation National Market System, because automated trades must be able to move immediately to the best price. And there are 16 exchanges and 30 some dark pools, broker operated alternative trading systems. And wherever the best price is, orders, unless you specifically say, I'm going to do an intermarket sweep order that stays at the NYSE, it must route out to the best price. Well, if there's a data failure, like you go and you route to IEX, but it's not connected, then you declare self-help and you skip them because you have to have a regulatory reason for skipping them if they have the best price. So that stuff occurred. I mean, it was happening this week like crazy. And I thought, what in the world is going on? I don't think the mayhem could have been. Now, would the SEC have some tests in there? Quite possibly. I saw some of the volatility halts and they were test signals. I absolutely saw that. But I cannot imagine that they would do that to BRKA because they had to bust all those trades. Very unpleasant, to people get furious about that. So I don't think so, Steve, but who knows for sure.
Thank you.
Yeah, not sure if it was helpful, but anyway, so this feeds into entries and exits and getting stopped out. So going to the data, if I just go, I'm gonna have to zoom back out here. By the way, if you notice a few things look a little different, it's because we have done some .NET updates. We actually had a problem today where Microsoft drives me batty. Why you would have Why your own system would be incompatible with a previous version is beyond me. But we had a little issue and we had to add some data. We're doing some stuff, and so there's a slightly different look and feel. I'm not sure I like it. I'll be curious to get your feedback. I'm not a fan of this gray. I think it should just be white, because I think if you click through a portfolio, then it looks cramped to me. See how that's? I don't like that, but I'm in the minority at present internally. So let me know what you think. Back to the point. So if you're looking at volatility, look at the daily trading ideas. If you look at there are only 4, by the way. Not a time to trade momentum, clearly. Even though the market is statistically bottomed, I'm concerned about the fact that maybe it's today. Maybe we'll have I don't know. I don't know what's going to happen. I only know what the data indicate are the probabilities. But look at this volatility. I mean, so we sort for things with at least 3% volatility, so we have a chance to capture 2% of it in 1 to 5 days. Well, you add that up, it's over 5% with average, right? So that's very volatile. Thus, the probability of getting stopped out if you're 1% below your entry point is much higher. So then, what do you do to compensate? Well, you have 2 choices. You either buy things that are flat or actually up a little bit instead of down half the volatility, because they've already got some movement, or you have to set a wider stop, or you don't trade them. I mean, there are actually 3 choices, right? I get a little squishy whenever supply and demand are converging. Those are the times, it only happens 10% of the time, basically, where I'm more interested in shorting the market, which, as I said, been a little challenging. But right there, that will tell you. It's a great way to know. If you look at the volatility average and it's 5%, realize that you're probably going to have a greater risk of being stopped out. So then how do you lower the risk? Trade low volatility. I mean, statistically, there is the same probability of producing a return. It's just half the return. And if you did the same thing here, and if you use Edge and you go to the momentum and low volatility portfolios, you can export it to Excel, which I have done. And you can just go look at the volatility and say, well, what is it? Because this will be a pretty good read on the market, because it's low volatility. We all are trying to protect ourselves from volatility. If we're using institutional managers, that's what they're doing. I mean, that's what Gunlock is doing. I've got money with that in a bunch of Gunlock funds, long-term money. JP Morgan trying to dampen volatility. Well, there's your average, 1.7% in the low volatility portfolio. Should be about 1.4. So that's a significant difference. It's like a 25% increase in volatility. Okay, once again, it's going to be the risk of getting stopped out is greater, because here's what we're counting on. It's pretty simple stuff. What we're counting on with this is that because demand exceeds supply, what is the probability that the machines setting all the price are going to back up and take your order out, take your stop out? Well, when the demand is rushing into the market, it's very low. When it's not, then the machines are going to hunt around. If the machines cannot clearly determine whether the market is going to rise or fall, they're going to go look for stops. And I'm still convinced, though, Doug Sifu, the CEO of Virtu, will swear up and down, no, we don't see the trades. I'm not sure I believe it. Sure, I believe it. When a broker says that in this facility one can access resting orders, that to me says that they can see them, because your stop and limits are resting orders in effect. By resting, I mean they're not getting executed. They're sitting there waiting in a queue, meaning someone could come by and trigger it. And as I've said before, machines are doing that. Machines are going to look for it, and the probability that it happens greatly increases when the direction of the market is unclear. Machines are wanting to make a tenth of a penny. They don't care. They're just calculating, as we do, a probability that occurs in a short period of time. So what's the lesson from this? Go ahead, jump in. Yeah.
Well, my question, so
yeah.
Sorry, Tim. I was curious, when you see these names in low volatility, how much do you look at the names that are populating these portfolios and say, we're at the end of a move? Like when I look at momentum and I see Robinhood in there, I go, well, that's not that's not a marquee name to me. Not only do we have a low number of momentum names, I look at all those names and I go, that's not the pool I want to be swimming in. How much is that? Do you recognize that at all?
I'm glad you made that point, Henry, because I was going to note that. Look at market cap. I'll always come and look at that. Look at those. They're basically mid caps. I mean, we everything above 5 billion in market cap we'll look at. It's stuff below that really difficult to trade. There's you can't get in and out. It's not doesn't mean you can't do it. But we're not going to officially present that stuff because it's too risky. But you're absolutely right. I look at this and say, I don't want anything to do, as good as the odds are, I don't want to trade that because we're down to the dregs. We're in the mid caps. And there are less than 300 of them that are worthwhile in the entire market, believe it or not. That's using Wilshire data. And then you go look at low volatility. And if you took an average of market cap, it's 500 billion. Of course, it's skewed by a handful of folks in there, but that's clearly where the money is. All right. So we want to be playing where the money is and where we have a lesser probability of being stopped out and a greater probability of producing a return. So, look, if the market doesn't give us a clear indication of direction, then you want to take a smaller gain. All we're trying to do is reduce the risks and increase the probability of producing a return. It doesn't always work. And Henry, I'll hand this off to you with one. I'm going to, because I don't want to chew up all the time. I'm going to look at CELH as an example here because I had a pre-market limit in when it was in the momentum portfolio, high probability of return, and I had a stop in too. I just put a bracket on it, and I want to say it was basically, if this is the data for the 24th, would have been the 28th. I think the 28th when we traded. And I bought it. It was like boom, boom. Instantly I bought it and got stopped out. I mean, what the? I knew it wasn't reporting results. So, what caused that? Well, there are edge cases. An analyst downgrade rarely has that kind of effect. The biggest thing to me is if I look at the amount of time it spent at 10 and the fact that everybody had covered in here. I mean, is there anything I would have done differently? No, but it is the reason we were right at the end of its momentum. No matter what occurred, it's probable that it would have been out of that portfolio the next day. I don't know for sure. And so you say, well, what Quast, how's that helpful to me? Sometimes there are just edge cases and there's nothing you can do about it. But I think the fact that it had been at 10 for so long and right into month-end options, MSCI rebalances, all that stuff happened on the 30th and 31st that I caught that risk. And now, fortunately, it didn't hurt me, but you don't expect that to happen. You think you're in the clear and you're not. And sometimes that's just the case. Okay, I'm going to stop there, Henry, and I'll let you take it away.
Great, that was a great look. Well, thanks, Tim. I'm gonna go to the 101 edge now. And I'm gonna start.
And I'll interrupt you if I can, but Steve, you got something? Sorry about that. You good? Okay. Keep.
So I'm on the other side. I'm on the East Coast, as opposite of Colorado, up in central New York, and it's thundering and raining. So if you hear the rumbling, there's no earthquake outside. So I'm going to show you. I'm looking at our momentum portfolio, but I'm going to start over and walk through the basics. Just really the basics of what I look at. First of all is obviously broad market sentiment, but Tim mentioned it on Tuesday. We really don't have any risk events until Friday. And so when I see that there's not something on the calendar that's coming up, I'll actually, despite the low short volume, we know that this is an entry point. This is historically an entry point here at the green line. you can go back further on the calendar where you see, yeah, when we get to the green line, we have short volume falling. Even here, this becomes an entry point. So maybe a little bit early to get moving into like a long trade. But knowing that we don't have a risk event coming up, I mean, every day it feels like we have something on the calendar. But if I know I have 2 good clean days, I feel a lot more comfortable holding multiple days if I know there's not a big data release or something coming up. So first of all, I'll look at broad market sentiment. I'll move it backwards just to remember where we are. This long short thing I've mentioned quite a bit on broad sentiment. And then after I look at broad sentiment and I see where we're moving, the next thing I'm looking at is the number of names and momentum and the number of names in low volatility. As I mentioned, I asked Tim, I said, what's the, when I see hood in our momentum portfolio, it doesn't give me the warm fuzzies. So it's again an opportunity to move to our low volatility portfolio. The other thing so I look at momentum with 6 names, I look at low volatility, just bringing up these names and seeing by market cap, like what are these names in here? When I see Google, which has had like just a huge change in short volume, right? Like I mentioned it a week ago, and we knew that short volumes were high, but then as this sold off, as the short covering happened, we could still see the stock rise. So the point I want to make is in one of the portfolios that I follow a lot is big tech, and what that does for me is this is the sort of the third part. There that thunder was again. I'll go in here, and I'm well aware of Tesla tends to run quite a bit higher on the supply side. I look at the alignment of are all these coupled together. My hesitation right now, despite all these big names having relatively lower short volume, is that they're all at 5. If we don't see a follow through on sentiment, we're gonna have an issue like that. That to me, I still have some confidence here that we have low short volume, but until we see these names starting to move up, I don't want to find out tomorrow morning that we have that sort of, tomorrow morning becomes the catalyst, the jobs number becomes the catalyst for some sellings. So those are the 3 things. The first is broad market sentiment. The second is the number of names and momentum and low volatility. And then just looking at where's big tech moving, because most likely, we'll talk about closet indexers. I'm a bit of a closet indexer because I don't want to be fighting upstream from these big names that are inevitably going to have an impact on the market. In the same respect, I want to be in names that money's flowing to. So yesterday I mentioned Google. Even if in a name like Google, you're not trading, you're not buying it on the open, if you're just waiting for that intraday volatility, I feel like that's a trade that you can have. The point of edge data is you can have a high degree of confidence in buying that little bit of a dip. And again, we're not trying to pull 6% at a time. It's 2%. Do that consistently at size, and you're going to be successful. And then the final thing that we do as we read our desk notes is, again, I'll look at momentum. I said it on Wednesday. There's just not a whole lot that's attractive there. There's some of these higher volatility names that if you have the time and energy to sit there and watch them, we have probabilities on them. But if you're just looking for something that's not going to wipe you out, you're going to look at low volatility. And I tend to just say, what up here, the first thing I'll do is I'll pull up the name, and then I'll bring it up in, on my browser and just say, what's this look like? Does it have that excellent momentum going forward? And then after that, I'll look at our volatility metric, and I'll set a purchase price. And, sometimes I don't hang around for a 1% loss. So sometimes it doesn't move like it should, and I'm out. There's no, it's no sweat off of mind back if I don't see that thing move the way I want it to, that I need to stick around to take the 1% loss. If it doesn't move like we expect, we just move on. So that's my daily process. Again, I mentioned the hesitation I have in our big tech portfolio is that if we don't see broad market sentiment demand manifest, and if we don't see it manifest in these bigger names, that despite the low short volumes, we need, there have to be buyers. But we're on a calendar into expiration. So if we just bump around where we are right now for another 8 days, that's probably the most likely. So again, and I'm just looking for that daily volatility, and I'm not really concerned if it's a long trade or it's a short trade. I know that even if Nvidia is up 4.5% yesterday, likelihood is that it's going to have, like, it searched out a new high and it's going to pull back. So if I take just a portion of that, I can be confident. And if that thing doesn't move like I want it to, then I don't have to stick around for a loss. So that's all I have to share. Tim, any comments, corrections that you want to make?
No, I'll do this. I will show you the calendar. What I was thinking of is there's actually a Russell rebalance. It goes in tranches. So I'll just point this out really quickly. It's over at Market Structure Edge. You can go over here, go to resources, and there's the 24 calendar. That's where I am. So I was thinking there was something on the calendar on a week from tomorrow. Of course, jobs data tomorrow. That is one of the Russell rebalance days. They do it so they internally, for their customers who are buying that data, because they're selling intellectual property, they send out an update on the rankings on the 14th. And then they do another on the 28th. And then it's complete. I forget. Maybe it's on the 28th, but I think it's announced officially right in first part of July. So if you look at the calendar for June, look at that messy week, not next week, but the following week. So VIX hits on Tuesday instead of Wednesday. Usually VIX expirations fall on Wednesday, but that's a market holiday. So then is there arbitrage opportunity in there? Yeah, it's pretty messy. I don't know what the market's going to do. Statistically, you would look at the data and say, well, it looks if we're at a statistical bottom, and if demand is below the green line and supply is falling, probably that's a bottom. But again, I'll say that we didn't get the decline that the market should have given us. So does this mean we're going to do a double dip? I don't know. We'll just take the data, each day. But to Henry's point, yeah, statistically, we're at a bottom. 3.9 is a bottom. Here, great. This was a great time to buy. Of course, it also dropped again with month-end options expirations. You have to watch. That's why we watch all those things. You look at options expirations, market tanked, and then it recovered because we were below 4. Then we get to here, tanked again, but then we were off. Those expiration dates are very important. Just good to know. That's all I've got. Any words of wisdom? It looks like you found something very useful to do, Barry Bailey, while we're doing this. Good thinking.
Yeah, I had to have some cavatini while we were trying to make some money here.
Cavatini. I like it. Any parting questions, comments, thoughts? If not, we'll let you go early. Kind of early. Steve, you're all teed up to say something there. I see.
Same question as I had last week. Trying to protect yourself. I'm still keeping track of all of this, and it's been a dive bomb. And a lot of it is because of the opening prices on some of these stocks that you go into.
Yep.
And it opens up 5 down or whatever, 5% down. How do you protect on that? Because I'm all the way back down to just barely being above break even.
Oh,
and just following statistically.
Yep. Yep. Well, I'll tell you, this is why I think that when demand falls, if one were to take the least risky approach, you would sit out. When we ran, I've mentioned this before, we have an engineer who built a performance module, and we used a risk management overlay that said, when demand falls, you sit out. And we're only in the market when demand is rising or topped. Once it begins to fall, we're out, because statistically, how I think about this is there is money coming into the market, and that has an effect that carries through, and then money stops coming into the market. It doesn't even need to leave. And if demand stalls, machines will begin to lower the price, because machines have an investment horizon of a day or less. They really don't care like you and I do. And so those conditions, I think, make it harder. And you're absolutely right. I found it too. I got stopped out of a number of things. And so when that happened, when I was stopped out of 3 things, I shifted to shorting. And I just use broad market shorting, and I'm only going to do it infrequently, because there's higher risk, it's less statistically predictable. We don't have a probability. I'm only going to do it 10% of the time, but I'm convinced that's part of it, and it all comes back to the mechanics. Machines are not going to stop you out and create all this volatility, the enormous movements that we had, if money's coming into the market. Once it's not, I think it gets risky. So maybe the thing is, if you get stopped out twice in a row, pull the plug on it, and either shift short or just sit and wait. Sometimes sitting and waiting is best.
Much of it was news.
Yep.
And they don't bring out the news until like 2 minutes before the open. And that it's just like nothing you can do to control that.
Yep.
And all of a sudden you're taking a 5% drop. So
yeah. No, I hear you. Again, I think if the risk goes up, the wise thing to do is don't trade. Barry Norton, you were going to offer an observation.
Yeah. So the way I've kind of developed 3 rules for how I trade the recommendations.
Okay.
The first one is it's got to be 100%. I don't play with the 90s unless maybe it's an NVIDIA or a stock that I know really well. But I take the 100%. Second thing is that it has to have options liquidity, meaning a good bid-ask tight spread, right? With lots of open interest in the options change. That way I know the market's going to pay attention to it. Doesn't necessarily mean I buy the options, I'll still buy the stock. And then the third is I like for the stock to open and then follow the rule that if you're down half the volatility, that's your good sign. And I found those 3 things to really help me. If something's at 100% and right at the open it runs, I just let it go. I just say bye-bye. But those are the 3 rules that I've been using.
Okay, that's helpful.
So Barry, you're not putting in a buy pre-market?
No.
Okay.
No, I like to just click my mouse manually and let the stock open and see how the market makers are playing with it with the stock.
Okay. Yep.
Then do you set a buy at the half volatility?
So I use Thinkorswim. What I do is I go in and I put in alerts. So if there's a buy range, I put in alerts. And when those alerts go off, then I can go look at it. And then I'm clicking. And sometimes it'll click the upper alert, but it may continue down a little bit more. So that's when I'm watching it closely.
I'm sorry you're with Thinkorswim. That's very sad.
Well, I was to your point.
It's been a nightmare.
Very to your point. To your point of setting the alert, that way you can look at it. If that alert hits really fast and that bar is violent, you're not just buying it on a violent bar. Like you're just saying maybe this isn't the right trade, right?
Exactly. I'm looking at. I also use book maps, so I'm looking at what level 2 quotes are doing as well, where I can see, support and resistance in the options. So that's using Bookmap also helps me. So it's just a combination of those things.
Have you had trouble with Thinkorswim?
So I've been using Thinkorswim just for charting since 2016, but I'm also a Schwab customer. So I'm migrating over to, I've got some proprietary studies that I use in Thinkorswim. So yes, it is complex, but all in all, I do like it. I'm a Mac guy, so I've had to really go out and buy some very powerful Macs. I mean, I have computers that have the M3 chip with 128 megs of memory. So you can do the math on that cost. But that's what an Apple fanboy does. But that, I have no problem, throwing the amount of charts that I do.
You haven't had any trouble with the transition. I've just had nightmare after nightmare after nightmare of not being able to get on. All my watch list left. It's
So
one thing after another since Schwab took it over.
Yeah, I had the benefit of already having the TOS account, and you had to keep $2,000 in it to get real-time quotes. And so I had that account. So for me, I've been able to bridge things over and send over studies and things like that. So I haven't had the nightmare, but I've been preparing for it since, because I called Schwab and I said, okay, you bought Options Express. You guys screwed that up. Okay, that was a great platform. You screwed it up. What are you doing this time with TOS? I asked them 4 different times, and they said, we're not touching TOS. I said, okay, great. So the only thing I've got a problem with is you transferring accounts from Schwab over to TOS. And they said yes. So I've been preparing for about the past year. So it's been an easier transition. Not saying it's been easy, but it's been an easier transition.
I was with TD, and the transition has just been horrible for me. I've spent almost an average of a half hour a day online with their technical people.
Wow, that's sad. I'm sorry to hear that.
No. They've rebuilt, they've redesigned it, they've brought it back over twice, and it's just been unbelievable.
So
I'm ready to go to IBKR. Look at that smile on Tim's.
Well, I've got a meeting coming up with the guy who runs Thinkorswim. So I'll relay this information.
Yeah, I use Thinkorswim. I use the desktop version of Thinkorswim.
Okay.
Okay, I'm using the app.
Yeah, I use the desktop version. That's a lot.
And Pam and Gary and Bob, thanks for the input.
There's some complexity, but the desktop app is much easier to use.
Okay. Interesting. Okay.
We'll get off of our TD thing here. I'm sorry to take up market structure edge time with this, but
that is okay. It's good. It's good to know. And I'm
frustrated.
I'll have a chance to convey it. The guy who's responsible for that platform is a very nice fellow. I've known him a while, but they're just about finished with the transition. So we're gonna chat about Edge. But I'll relay this. Okay. And Pam, to your point about the first 10 minutes, I would even go further and say between 9:30 and 11:30 Eastern time, a chunk of that time, that's high frequency trading. High frequency traders are trying to figure out where the reference price is going to be at the end of the day, because that's where the exchanges make their money. The whole day they're paying people for trades to try to get trades to come to them, and they lose money. But in the last 20 minutes of the day, the exchanges can charge for both sides of the trade, buying and selling. The market's called a maker-taker market. They will pay you to make liquidity, and they'll charge you to take it, except they run what are called inverted platforms too, like the BSX at NASDAQ will pay you to buy. So you could go to the NASDAQ and the BSX and pay you on one platform to sell and pay you on the other to buy. Why? To set the bid and the offer. If you have the bid and the offer, you get order flow. And what matters is the order flow that is not displayed. And that's what the high frequency traders are trying to figure out. They're trying to figure out, is there more buy demand or sell demand in those orders? So in that first hour of trading, they're moving prices. And that's why oftentimes the market will go like this. And then because they're trying to take out all of that stuff, the same thing they do to us, very same thing. So you're right, Pam. And I think, how do you avoid that? The thing that will tell us is demand. When broad demand stops rising, those conditions exist. And our risk of getting stopped out is going to go up. And I think then the Barry Norton principle applies. You might as well, I'm not going to put in a limit order if I'm going to get stopped out. I'll do like you do. And maybe I have to wait for it to go down half or even all of its volatility. That works even better during these periods. Yep. I mean, you could have made money on nearly every one of the momentum trades, buying it down half or all of its volatility the last week. Even though a lot of them closed down, you would have made 2% because there was so much movement in the market. But that's to me the key. Broad sentiment deteriorates. Watch out, you're going to get stopped out a lot more. Switch to the Barry Norton rule, right? All right, you guys. I was going to keep it short, but this was too good. This was a good discussion. I appreciate all of you weighing in. Thank you.